So the big question is this: how do investors like us who trade options and manage our own money generate income regardless of where the stock market goes, and do it all in a way that lets us make time for the people and things we love, and yet still build wealth and remain profitable? That's the question, and this podcast will give you the answer. I'm your host, Kirk Duplessis, and you're listening to The Daily Call from Option Alpha. Hey everyone, Kirk here again from Option Alpha, and welcome back to The Daily Call. Today we're going to talk about the basics of trading options with margin. I think this is an interesting topic to talk about because most people get started in options trading. They understand that they have to open up some sort of account that allows them to do trading. One of the accounts that you can open up is what's called a margin account. And so I want to describe basically what margin is and why it's available, what happens, how it's used to cover positions, etc. So basically, what is margin and why do you need it? Well, to understand margin, you have to first understand that it mostly applies to option sellers. Now, some accounts may apply margin to option buyers, but it's not traditionally how it's done. When you start trading options, if you buy options as the first course of business, which most people might start by buying an option contract, they buy a call or buy a put, those contracts do not require any margin. And they don't require any margin because those contracts are contracts where you outlaid money and you have the potential to lose that money, but you had that money in place to begin with. Meaning, if an option contract costs $100, you paid $100 to be able to get that option contract. So the brokers understand that you understand, because you paid the money for it, that you have the ability to lose $100 on that trade. So your risk is covered by the initial investment that you already made in that contract. So hopefully that makes sense. You are covering yourself by buying that contract. You're risking your own money and you could lose that money. And when you start trading options and start selling options, where you are no longer an option buyer but an option seller, collecting a premium and then basically promising to pay out if you lose, that's when margin accounts come into play. Margin accounts then allow the broker to allow you to sell options. And what they do is they basically take a chunk of money from your account and basically put it aside to cover the risk in that trade. So it's not that they physically remove the money from your account, but they basically say, okay, look, if you've got $10,000, then $1,000 is going to be put aside in your account, is going to be sectioned off, if you will, partitioned from your ability to trade, because that $1,000 has to cover the new option contract that you just sold. So if you sold an option contract for $100, so let's say you're on the other side of our example that we used in the beginning of the podcast, now you sold an option contract for $100. You collected a premium as an option seller from the option buyer, but now you have to put aside some money in your account in case the trade just goes bad. That's really what it comes down to. You have to put some margin of capital in your account aside in case you're wrong and the contract goes up a ton in value and you have to, let's say, buy back the contract in the open market for $500. So you lose $400 in total. So you have to put some of that money aside in your account. And again, brokers do this automatically through what's called a margin schedule. They put aside money based on implied volatility, expected move in the stock, percentage thresholds that they use. Different brokers have different schedules, so check with your broker, understand what they do. But they put that money aside to cover the potential loss in that position. Now, in most cases, they put aside, like, let's say, the loss that might happen at a 2 standard deviation level. So go back a couple podcasts, you can listen to the one that we did on expected moves, but they would calculate, hey, how much money could you lose if the stock makes a 2 standard deviation move? Great, then we're going to put aside that amount of capital in your account, right? It's a very common thing to do. But again, it's not that they're taking that money out of your account. They're not withdrawing it. They're just not allowing you to trade it. They're not allowing you to invest and double down on your bets by also trading your $1,000 and buying something else, because you've got to have money to make good on your position. That's really what it comes down to. This entire market is predicated on people making sure, and brokers and clearinghouses and exchanges making sure, that if you say you are going to enter into a contract and somebody else enters into that contract with you, that both parties have the capital resources to make good on that contract. That's how efficient markets really work well, when both parties have the resources in place to either pay out if they lose or to have the ability to collect if they win, right? That has to be a factor in efficient markets. And so that's where margin comes into play. So again, you don't have to have a margin account to trade options. Margin accounts are ways that you can trade undefined risk strategies. You can trade undefined, or you can trade defined risk strategies in any IRA, retirement account, etc., where you have defined risk. So the only difference between, let's say, a traditional margin account and being able to trade elsewhere is that strategies in most cases have to be defined risk, meaning you can't have naked lingering options, naked calls, naked puts, etc. Everything has to be basically a spread. You have to buy a call and sell a call at the same time, or sell a put and buy a put at the same time and do a spread. You do those, you still have the ability to do those in other types of accounts. So hopefully that helps out. Hopefully it maybe clears the air and gets you started if you're just getting started with options trading and kind of learning some of the basics. As always, if you have any comments or questions, let me know. Until next time, happy trading. Thanks for joining us on the Daily Call. Be sure to subscribe right now for more daily options trading ideas, strategies, and tactics to help you learn how to place smarter, more profitable trades. And if you like what we're doing, don't forget to give us a rating and a review so we can continue to bring you the best daily content possible. We'll see you again tomorrow, right here on the Daily Call from OptionAlpha.com.